Are you living that dream abroad? Immersing yourself in a new culture, maybe building a career somewhere exciting and foreign. It sounds amazing, right? But then the tax forms land on your doorstep. And suddenly that dream feels like, it's turning to a bureaucratic nightmare. That fear of double taxation, the sheer confusion of all these international tax rules, it can feel like a real cold splash of reality. But what if I told you there's a powerful, totally legitimate tool designed specifically to save you from that headache? One that could potentially put thousands, seriously, thousands of dollars back into your pocket. Our mission today is to unpack that, let's face it, formidable looking document, RS Form 25555, Foreign Earned Income. We're going to show you exactly how it can be your shortcut to some pretty significant tax savings if you're a U.S. citizen or resident alien working overseas. By the end of this deep dive, you'll understand the core strategies to cut down your U.S. tax bill on that foreign income. And hopefully you'll feel a lot less overwhelmed and, more in control. This isn't just about a form, it's about unlocking real savings.
Yeah, and what's truly fascinating, or maybe frustrating, depending on how you look at it, is how often people leave serious money on the table, just simply because they're unaware these provisions even exist. These rules are specifically designed for their unique situation as expats. You're right, this form can offer immediate relief. And it's not just compliance, it's really about maximizing your financial well-being while you're living this international life. We're going to break down the nuances, the common pitfalls people fall into, and the strategic advantages that can make a monumental difference to your bottom line.
Exactly. That's the goal. So let's jump right in. The core mission of Form 25555. What is this thing and why is it so critical for anyone working outside the U.S.? At its heart, Form 2555 is your gateway to those tax savings we mentioned. Its main job is to help you figure out two really big tax saving tools, your foreign earned income exclusion and your housing exclusion or deduction. It tackles that fundamental challenge for U.S. folks abroad. Even when you live and work in another country, you're generally still subject to U.S. income tax laws, which can lead to that dreaded double taxation, paying taxes where you live and work, and potentially, again, in the U.S. 555 is the relief valve for that pressure.
That's a perfect way to put it, the relief valve. And it's super important right off the bat to understand what the IRS means by a foreign country. Because, well, it's not just any place outside the 50 states. Specifically, a foreign country is any territory under the sovereignty of a government other than the U.S. government. And this definition is surprisingly broad. It includes the country's territorial waters, its airspace. So if you're working on an offshore oil rig in, say, Mexican waters, that counts.
Oh, interesting. Even the airspace.
Yeah, even the airspace. Think pilots spending a lot of time flying over foreign countries. It also covers the seabed and subsoil of those adjacent submarine areas where a country has exclusive rights to explore and exploit resources under international law. So it's, more than just the landmass. But, and this is a crucial distinction, one that trips people up all the time, it does not include U.S. territories. So we're talking Puerto Rico, Guam, the U.S. Virgin Islands, the Northern Mariana Islands. Nope.
So working in San Juan doesn't count for this, even though it might feel foreign.
Exactly. For IRS purposes, it's not a foreign country, and the Antarctic region is also specifically excluded. This precise definition of where your income is earned, and critically, where your tax home is located, that directly shapes your eligibility for these exclusions. If you step back and look at the big picture, this form really reflects the U.S. tax system trying to, well, facilitate international business and living. It acknowledges the complexities of being a global citizen while still holding on to its principle of worldwide taxation. It's a balancing act, really.
That distinction really hammers home the need for precision here. Okay, so we know what counts as a foreign country.
Yeah.
Now, who exactly gets to claim these potentially huge savings? You mentioned it boils down to two key requirements. First, you've got to pass the tax home test. And then you also have to meet either the bona fide residence test or the physical presence test. Is that right? Both parts needed.
Precisely. You nailed it. It's always the tax home test plus one of the other two. Let's start with the foundation, the tax home test. To meet this, your tax zone has to be in a foreign country or maybe multiple foreign countries throughout your qualifying period, whether that period is defined by the bona fide residence test or the physical presence test. Now, your tax home isn't necessarily where your family lives or where you own a house back in the States. It's defined as your regular or principal place of business, employment, or post of duty. That's the key where you work. If your job doesn't really have a regular place of business, maybe you travel constantly for work, then your tax home is considered your regular place of abode, basically where you normally live. Okay, now here's a crucial caveat, and honestly, this is a super common pitfall. You generally aren't considered to have a tax home in a foreign country for any period when your abode is in the United States. Your abode, and think of like your home base, your domicile, where you live. It reflects where you maintain your family ties, your economic ties, your personal connections.
Okay, wait. So if I'm working abroad, let's say I'm physically in Germany for my job, but my spouse, kids, house, bank accounts, everything is still back in, say, Texas. I might not qualify even though my job is overseas.
That's a really insightful question, and it gets right to the heart of the abode rule. You might be out of luck in that scenario.
Yeah.
Think about the classic example the IRS uses. Someone working on an offshore oil rig in foreign territorial waters. Maybe they work a 28-day on, 28-day off schedule. If, during those 28 days off, they consistently fly back to their family home in the U.S., keeping all their main personal and financial ties there, well, the IRS says their abode is in the U.S. And in that case, even though the work is 100% foreign, they would not meet the tax home test. So they can't claim the foreign earned income exclusion or the housing deduction.
Wow.
So understanding that difference between your tax home, where you actually do the work, and your abode or family residence, where your life is centered, is absolutely critical to avoid being disqualified. It's a subtle but really important distinction. There is a special exception, though. It's for individuals serving in a designated combat zone in support of the U.S. Armed Forces. These individuals can establish a tax home in a foreign country, even if their abode is technically considered to be in the U.S. The IRS publishes a list of these combat zones. You can find it on irs.gov. It shows they recognize those unique circumstances.
Right. That makes sense for military personnel. It definitely sounds like the IRS is trying to figure out where your life's center of gravity really is. Okay, so nail the tax home test first. Then you move to part 2, proving your connection to the foreign country. Let's look at option 1, the bona fide residence test. This one feels, well, a bit more subjective. It's about intent, right? Showing a real connection.
It absolutely is more about intent. It's less about just counting days. To qualify under the bona fide residence test, a couple of things need to be true. First, you have to be a U.S. citizen. Or you could be a U.S. resident alien, but only if you're from a country that has an income tax treaty with the U.S. that covers this. Second, you must be a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year.
An entire tax year. So for most people, that's January 1st to December 31st of a specific year.
It's exactly. For a calendar year filer, you need that full Jan 1 to December full 31 stretch within your period of bona fide residence. Now, uninterrupted period refers more to your intention to reside there. It doesn't mean you can literally never leave the country. Short, temporary trips back to the U.S. for vacation or even business generally won't break your bona fide residence as long as your clear intention is to return to your foreign home afterward. The whole determination really hinges on your intention regarding the length and nature of your stay. The IRS looks at what you say, but more importantly, what you do. Actions speak louder. If you go abroad for a very specific temporary purpose like a 6-month consulting gig and you fully intend to pack up and come back to the U.S. right after, you probably won't be considered a bona fide resident. But if achieving your goal requires you to stay for an extended, indefinite period and you actually make your home in the foreign country, you integrate, you get a local driver's license, open local bank accounts, maybe enroll your kids in local schools, join local clubs, you're showing a deeper commitment, then you might well qualify.
Oh, yeah, that makes sense. It's about planting roots, even if temporary ones.
Exactly. But here's a huge point. A real aha moment for many, and honestly a massive trap if you're not careful. If you have ever submitted a statement to the authorities of the foreign country, the country where you're claiming bona fide residence, saying that you are not a resident of that country for their tax purposes, well, you generally cannot qualify as a bona fide resident for U.S. tax purposes.
Whoa, hold on. So if I tell, say, France, hey, I'm not a resident here for your taxes, maybe to get some tax break, they offer non-residents.
Then the IRS essentially says, okay, you told France you're not a resident, so you can't tell us you were a bona fide resident for our purposes. It's a direct contradiction.
Wow. That's huge. You could accidentally disqualify yourself from the U.S. exclusion by trying to save money on foreign taxes.
Precisely. It's a classic example of how actions taken with one tax authority can have unintended and potentially very costly consequences with another. You could lose out on potentially excluding over $126,000 from U.S. tax because of that statement. Big heads up there.
Definitely a big heads up. Okay, so if the bona fide residence test feels a little interpretive based on intent and actions, the physical presence test sounds much more straightforward. It's just about counting days.
You got it. The physical presence test is purely quantitative, black and white.
Mhm.
For people who like clear rules, this is often the way to go. To meet this test, you, as a U.S. citizen or resident alien, just need to be physically present in a foreign country or countries for at least 330 full days. And that's during any period of 12 consecutive months. A full day means a continuous 24-hour period starting at midnight. So if you arrive in a foreign country at noon, that day doesn't count. Your first full day starts the next midnight. Same logic applies when you leave.
Okay, 330 full days in any 12-month stretch.
Right. And importantly, those 330 days don't have to be consecutive. You can bounce back and forth. Add up all the separate periods you were physically present in a foreign country during that 12-month window you choose. So let's say you pick a 12-month period starting July 1st, 2024, ending June 30th, 2025. You could travel back to the U.S. for holidays, take a vacation elsewhere, as long as you rack up 330 full 24-hour days physically within a foreign country or countries. By that June 30th deadline, you meet the test. Time spent traveling over international waters doesn't count. Brief trips into or flying over the U.S. also don't count for those specific days. But they don't necessarily break your 12-month period. They just don't add to your 330-day total for those travel days.
But you need to keep pretty good records of your travel dates.
Absolutely. Flight itineraries, passport stamps, that sort of thing becomes really important for proving the physical presence test. There's also a specific caution related to Cuba. If you were in Cuba in violation of U.S. travel restrictions, any time spent there cannot be counted towards your 330 days. And any income earned there isn't considered foreign earned income for the exclusion. Though, interestingly, working at the U.S. Naval Base at Guantanamo Bay is specifically carved out as an exception that doesn't count as violating travel restrictions for this purpose. Shows how specific these rules can get.
Wow, yeah, down to the specific location. Okay, but what if life throws a curveball? What if something completely outside your control forces you to leave the foreign country before you hit that 330-day mark, or before you complete your full tax year for bona fide residence? You know, like a war, civil unrest, maybe a major natural disaster, or even like we saw with the pandemic.
That's a really important question, and thankfully there's the provision for that. It's often called the waiver of time requirements, sometimes thought of as like an act of God clause, though the IRS calls it waivers due to adverse conditions. If your tax home was in a foreign country and you were genuinely a bona fide resident, or you were physically present there but you had to leave because of war, civil unrest, or similar adverse conditions, the IRS may waive those minimum time requirements. The absolute key here is that you must be able to show that you could have reasonably expected to meet the time requirements if those adverse conditions hadn't forced you out.
How do you show that?
Well, maybe you had a long-term employment contract, or you'd signed a multi-year lease on an apartment, or your family was settled in local schools. Things that demonstrate your intent to stay for the required period. The IRS actually publishes a list each year identifying the specific countries and the specific date ranges within the previous year where these adverse conditions were officially recognized. If you left one of those listed countries during the specified time frame, you can still claim the tax benefits on Form 25-550 but only prorated for the number of days you were actually a bona fide resident or physically present before you had to leave. And a practical tip, if you're claiming this waiver, you must attach a statement to your return. Explain the situation, show why you expected to meet the time requirement but couldn't. And you should also write claiming waiver right there on the top margin of page 1 of Form 2555. That signals it clearly to the IRS processor.
Okay, good to know there's some flexibility for those extreme situations. So let's say you've jumped through the hoops. You meet the tax home test, and you meet either the bona fide residence or physical presence test. You qualify. That's huge. Now, what income actually count? We keep saying foreign earned income.
Yes.
What does that actually cover? It's not just your base salary, right?
That's the only question.
Yeah.
Because, the definition is actually quite broad, which is good news. Foreign earned income includes your wages, salaries, professional fees, basically any compensation you receive for personal services you performed in a foreign country during that qualifying period we just talked about. And it's definitely not just cash. It explicitly includes non-cash income too. Think about the fair market value of things your employer provides, like they give you housing or lodging or provide meals in certain settings or give you the use of a company car. If these things have a clear value, that value is generally part of your foreign earned income.
Okay, so the value of perks counts too?
Absolutely. Yeah. And beyond that, various allowances and reimbursements also count. Things like cost of living adjustments, COLAs, to handle higher expenses abroad, overseas differential pay, family allowances, education allowances for your kids' schooling, home leave allowances to help you fly back to the States, quarters allowances, basically any amount paid by your employer either directly to you or on your behalf for the services you performed is typically going to be included in that foreign earned income total. If they pay your foreign utility bills, for instance, or give you a housing stipend, that's usually income.
That's pretty comprehensive. Makes sense that it captures the whole compensation package, but surely there are things that don't count, right? What are the big exclusions from foreign earned income? Where do people sometimes get tripped up?
Oh, absolutely. Knowing what doesn't count is just as critical, maybe even more so, because mistakes here can be costly. First off, pensions and annuity income are explicitly out. That includes Social Security benefits and similar retirement income. So if you're retired abroad but maybe doing some part-time work, only the income from the work counts, not the pension. Second, passive income doesn't count. We're talking interest, ordinary dividends, capital gains from selling stocks or property, alimony received. These aren't considered earned income because you didn't perform personal services to get them right. They're investment returns or other passive streams.
Got it. No passive income. What else?
Third, and this is a really big one for a lot of people, amounts paid by the U.S. government or any of its agencies if you were an employee of the U.S. government. So if you're a federal employee working at an embassy or military personnel or even some government contractors paid directly from the U.S. Treasury, sorry, this exclusion generally isn't for you. You can't exclude income that comes from Uncle Sam. Also, income received too late. Specifically, if you get paid for work after the end of the tax year following the year you actually performed the services, that payment generally won't qualify for exclusion. It's a timing rule to keep things current. And finally, amounts that are really just disguised corporate earnings or profits, not reasonable compensation for your actual personal services. This might apply if you own your own foreign corporation, for example. You can't just call the profits salary to exclude them. It has to be reasonable for the work you did.
Okay, that makes sense. What about self-employed people? You mentioned professional fees count, but are there special rules if you run your own business abroad?
Yes, there's a very important and sometimes tricky rule for self-employed individuals. It depends on whether capital is a material income-producing factor in your business. Think about it. If you run, say, a small manufacturing business abroad, you need machinery, inventory, maybe a factory space that's significant capital investment, right? Along with your own work managing it. In that case, where both your personal services and capital are important for generating income, only a reasonable amount of compensation for your personal services counts as earned income for the exclusion. And the IRS puts a cap on it. It's limited to 30% of your share of the net profits from that business after you subtract the deductible part of your self-employment taxes.
Only 30%.
Wow. Yeah. So even if your business with significant capital makes a lot of profit, the portion you can potentially exclude as earned income is capped at 30% of that net profit attributed to your services. However, if capital is not a material income-producing factor, let's say you're a freelance writer, a consultant, a software developer working from your laptop, your main asset is your brain and your time, right? Minimal capital needed. In that scenario, then 100% of your gross income from that self-employment is considered earned income. So nailing down whether capital is material to your specific business is absolutely vital for self-employed folks to calculate their potential exclusion correctly. It can make a huge difference in the amount of income eligible for the exclusion.
That 30% rule versus 100% rule is a massive difference for entrepreneurs. Definitely something to look closely at. Okay, so we know who qualifies, we know what income counts. Now for the part everyone's waiting for, the foreign earned income exclusion itself. This is where the real magic happens for many, right? The big number.
Yes, this is definitely the headliner. It's often the most significant benefit, and like you said, it can be a real game changer for expats' finances. For the 2024 tax year, assuming you qualify, you can exclude up to $126,500 of your foreign earned income. Let that sink in.
$126,500.
$126,500. That amount is a direct reduction of your income subject to U.S. federal income tax. It just vanishes from your taxable income calculation. You don't pay U.S. income tax on that portion of your foreign earnings.
It's incredible.
It really is. Now, keep in mind, that's the maximum for a full year of qualifying. If your qualifying period, remember, that time you meet the tax home test, and either the bona fide or physical presence test doesn't cover the entire tax year. Maybe you moved abroad in March, or you moved back to the States in October. Then that $126,500 limit gets prorated. It's based on the number of days in that tax year that fall within your qualifying period. So if you qualified for, say, 200 days out of 366 in 2024, your maximum exclusion would be roughly 2,366 times $126,500. You calculate it precisely based on days.
Okay, so it scales based on how long you qualified during the year. What about timing? Like, if you get a bonus paid in 2024 for work you did in 2023?
Good question. For cash basis taxpayers, which is most individuals, income is generally counted when you receive it. So that bonus received in 2024 for 2023 work. It might be excludable on your 2024 return up to the limit that would have applied had you received it in 2023. It gets a little complex, sometimes needs a statement attached, but generally it follows the year of receipt. Conversely, if you got paid in 2023 for work you did in 2024, maybe in advance that income could potentially be excluded on your 2023 return, often by filing an amended return, Form 1040X, once you qualify for 2024. There are specific rules around timing, especially for payments received before or after the year services are performed. But here's a point that's absolutely critical, especially for couples working abroad. This $126,500 exclusion, it's per person.
Oh, really? Per person?
Yep. Yes. So if you and your spouse both live and work abroad, both meet the qualification test, and you file a joint return, you can each claim the exclusion separately on your respective foreign earned income.
Wow. So a married couple could potentially exclude over $250,000?
Exactly. For 2024, if both spouses qualify and each earns at least $126,500 in foreign income, they could potentially exclude up to $253,000, $126,500 times 2 of their combined income from U.S. federal tax. That is an incredibly powerful tool for dual-income expat households. It can lead to massive tax savings.
That really highlights the potential impact. Okay, beyond that huge income exclusion, there's another tool you mentioned, especially helpful for people in really expensive cities, the housing exclusion or deduction. You called this a potential game changer, too. How does that work?
It absolutely can be, especially, in those high-cost global hubs where rent can be astronomical. It's designed to help offset those significant overseas housing costs. Let's start with what counts as qualified housing expenses. These are basically reasonable expenses you paid or incurred for your foreign housing. And that includes housing for your spouse and dependents if they live there with you in your foreign abode. There's also a narrow provision for a second foreign household, but only in really specific adverse situations, like if your tax home location is considered dangerous or unhealthy, forcing your family to live somewhere else nearby for safety. That's pretty rare, though.
So what kind of expenses are we talking about? Rent, obviously.
Rent, yes, that's the big one for many. Also, utilities count things like electricity, water, heat. But, importantly, not telephone, internet, or cable TV charges. Those are generally excluded. Other things that count: real and personal property insurance on your dwelling, non-refundable fees you paid just to get the lease, like key money, rental costs for furniture if you're renting furniture, residential parking fees, and even minor household repairs that aren't capital improvements. You can also potentially include the fair rental value of housing provided by your employer, but only if you haven't already excluded that value under a different tax rule. Section 119, which deals with lodging provided for the employer's convenience. It's mainly about the recurring costs of simply having that foreign dwelling.
Okay, so what doesn't count? You mentioned no phone or internet.
Right. Also, you cannot include expenses that you might otherwise deduct on Schedule A, like mortgage interest or real estate taxes. Those have their own deduction rules. The costs of actually buying a house or making capital improvements to it don't count. Principal payments on a mortgage are out. Depreciation on a house you own is out. Costs for domestic labor, like hiring a cleaner or gardener, don't count. And buying furniture or home accessories is also excluded. It's focused on the cost of occupancy, not ownership or lifestyle extras.
Okay, that clarifies the expenses. Now, how do you figure out the actual amount you can exclude or deduct? You mentioned something about a floor and a ceiling, which sounds potentially complicated.
It does sound a bit complicated, but it's logical once you see the pieces. First, there's the base housing amount. Think of this as the floor, or like a deductible. It's an amount of housing expenses the IRS assumes you'd incur anyway, regardless of location, so you cannot exclude or deduct this base amount. For 2024, that base housing amount is $20,240 for a full year, which is 366 days in 2024, a leap year. Or it works out to $55.30 per day if your qualifying period is shorter. You only get to exclude or deduct your qualified housing expenses that are above this base amount.
So you subtract that $20,240 first, basically.
Essentially, yes, for your total qualified expenses. Then there's the ceiling, the housing expense limit. This prevents people from claiming excessively lavish housing costs. Your total qualified housing expenses, after considering the base amount, generally cannot exceed a certain limit. And this limit varies significantly depending on where your tax home is located, because housing costs differ so much around the world. For most locations in 2024, the general limit is $37,950 for a full year, or $103.69 per day. However, and this is absolutely critical, the IRS publishes a notice each year. For 2024, it's Notice 2024-31, that lists specific high-cost locations around the world, cities like Hong Kong, Geneva, London, Tokyo. These places have much, much higher housing expense limits, potentially double or even triple that standard $37,950 limit.
So living in an expensive city actually makes this housing benefit more valuable, potentially.
Exactly. That's where it could be a huge help. If you move between different foreign cities during the year, you have to calculate the prorated limit for the time spent in each location and add them together. There's even a way to potentially elect to use future year limits if they're announced early and are higher, which could be strategic.
Okay, floor, ceiling, location matters. Now, how do you know if it's a housing exclusion or a housing deduction? And what's the difference on the tax return?
Great question, because the distinction depends entirely on who's footing the bill for your housing. You use the housing exclusion if your employer provides housing directly, like company housing, or reimburses you for your housing costs. The amount you exclude is the smaller of either your housing amount, that's your qualified expenses minus the base housing amount, or the actual amount your employer provided or paid for your housing. This exclusion works just like the main income exclusion. It directly reduces your foreign earned income before calculating tax.
Okay, so exclusion if the employer pays. What about the deduction?
You use the housing deduction, primarily if you're self-employed and paying all your own housing costs. Or it can also apply if you're an employee, but your actual qualified housing expenses, minus the base, are more than what your employer provided or reimbursed you for. Unlike the exclusion, the deduction isn't subtracted from your foreign earned income itself. Instead, it's taken as a deduction from your gross income, similar to, say, the student loan interest deduction. It's crucial to understand the order. You always calculate the housing exclusion first. You can only take a housing deduction if your qualified housing expenses, minus the base, exceed the amount you already excluded, and if your total foreign earned income is more than the sum of your foreign earned income exclusion plus your housing exclusion. It's like a top-up benefit.
So it's a bit more limited than the exclusion.
It can be, yes, because it's subject to income limitations. And related to that, there's a carryover rule for the housing deduction. If your non-excluded foreign earned income isn't high enough in the current year to allow you to take the full housing deduction you calculated, you can carry the unused portion over to the next tax year. Just 1 year, though. If you can't use it in that following year, it's lost. So you need to track any carryovers.
Okay. And what about married couples? Any special rules there for housing?
Yeah, similar logic to the main exclusion. If you and your spouse live in the same foreign household and file jointly, only one of you can claim the housing exclusion or deduction for that shared household. No double dipping on the same rent payment, basically. However, if you legitimately live in separate foreign households, maybe due to that adverse conditions scenario we talked about, or perhaps different job locations that aren't commuting distance, then you each potentially could claim the qualified expenses for your own separate household, assuming you both meet the tax home tests and other requirements. But the rules are pretty specific to prevent abuse.
Got it. These exclusions, both the income and the housing, sound incredibly beneficial.
Absolutely. But you hinted earlier that claiming them isn't always a simple yes. It has ripple effects, right? It's more of a strategic choice. What are those important considerations?
This is such a critical point because, yeah, claiming these powerful exclusions can impact your eligibility for other valuable tax benefits. It's definitely not always automatic that claiming them is the best overall strategy. Requires a careful look. First, let's talk about choosing and maybe later revoking the exclusions. Once you choose to claim either the foreign earned income exclusion or the housing exclusion deduction on your tax return, that choice stays in effect for that year and all future years unless you actively formally revoke it.
It sticks with you. It sticks. It's not an annual election. Now, if your situation changes, maybe you move to a country with super high foreign taxes or your income profile changes, you can revoke your choice. You do that by simply not claiming the exclusion on your return and attaching a statement saying you're revoking it. But here's the kicker, and it's a big commitment. If you revoke your choice, you generally cannot claim the exclusion again for the next 5 tax years without getting special permission from the IRS.
5 years.
5 years. So revoking is a major decision, not something to do lightly. It locks you out for half a decade unless you have a really compelling reason the IRS agrees with. You usually make your initial choice on a timely filed return or perhaps an amended return later.
Okay, that's a serious commitment. What about the impact on other tax breaks? You mentioned losing out on some things.
Yes, and this is often the most significant trade-off, especially for families or lower to moderate income earners abroad. Here's the big one. If you claim either the foreign earned income exclusion or the housing exclusion deduction, you cannot take the additional child tax credit.
The refundable part of the child tax credit.
Exactly, the part that can give you money back, even if you don't owe tax. That can be worth thousands per child. So if you have multiple kids, losing the ACTC could potentially cost you more than you save from the foreign earned income exclusion, depending on your income level. Similarly, you also cannot take the Earned Income Credit, EIC, if you claim these exclusions. The EIC is a major credit for working individuals and families with low to moderate incomes, so you absolutely must weigh the benefit of the exclusion against the value of these credits you'd be giving up. Run the numbers both ways. For some, the FEIE is clearly better. For others, especially those with several children and modest incomes, foregoing the FEIE to claim the ACTC and potentially EIC might result in a lower overall tax liability or a bigger refund.
That's a huge decision point. What about foreign taxes paid? How does that interact?
Another critical interaction. The rule is fundamental. You cannot take a U.S. foreign tax credit or a foreign tax deduction for any foreign income taxes that you paid or accrued on income that you excluded using Form 2555. Think about it, that income wasn't taxed by the U.S. because you excluded it, so you can't also get a credit for foreign taxes paid on that same income. That would be double dipping.
Right. Makes sense.
So if you exclude 100% of your foreign earned income, you get zero foreign tax credit for taxes paid on that income. If you exclude, say, 60% of your income using the FEIE, you can only claim foreign tax credits on the taxes paid on the remaining 40% of your income that is still subject to U.S. tax. You have to allocate or prorate your foreign taxes. This leads to the other major strategic choice. Should you claim the foreign earned income exclusion, or should you skip the exclusion and instead claim the foreign tax credit on all your foreign income?
The FEIE versus FTC decision.
Exactly. If you live in a country with income tax rates higher than U.S. rates, the foreign tax credit might actually save you more money than the exclusion, because the credits could potentially wipe out your entire U.S. tax liability on that foreign income and maybe even generate carryover credits. The exclusion just makes the income disappear up to the limit. The credit directly reduces your U.S. tax dollar for dollar based on foreign taxes paid. It requires careful calculation considering your income level, the foreign tax rates, the exclusion limit, and those other credits you might lose. There are also special rules that can limit your IRA deduction if you claim the exclusions. It's a complex interplay.
Definitely sounds like something you need to model out each year or get professional advice on. Okay, one more potential surprise you mentioned, the stacking rule for taxing the income you don't exclude. How does that work?
Yeah, the stacking rule, or technically how tax is figured on non-excluded income. It's a bit counterintuitive but important. Even if you exclude, say, the full $126,500 using the FEIE, any income you have above that amount, your non-excluded income, isn't taxed starting from the lowest U.S. tax bracket. Instead, the IRS calculates the tax on your non-included income using the marginal tax rates that would have applied if you hadn't claimed the exclusion at all.
So the excluded income still pushes your other income into higher brackets.
Exactly. Let's use your example. Earn $150,000, exclude $126,500. That leaves $23,500 subject to U.S. tax. The IRS doesn't tax that $23,500 as if it's your only income, starting at the 10% or 12% bracket. They figure the tax on the full $150,000 first. Then they figure the tax just on the excluded $126,500. The difference between those two tax amounts is the tax due on your $23,500 of non-excluded income. Effectively, it means your $23,500 is taxed at the higher marginal rates that apply to income between $126,500 and $150,000. The exclusion saves you tax, yes, but it doesn't lower the tax rate applied to your remaining income. You use a specific worksheet, the Foreign Earned Income Tax Worksheet, in the Form 1040 instructions to figure this out correctly.
Okay, that's a subtle but really important point for calculating the actual tax savings. Wow, we've covered the what, the why, the who, the strategic choices. Now let's get practical. The how. Filing the form. When do you need to file, especially if you're living abroad? And where do you send these forms?
Right, the nuts and bolts of filing. This is crucial for smooth processing. First, the deadlines. For a normal calendar year return, like 2024, the standard U.S. deadline is April 15th, 2025. However, if on that April 15th deadline you are both living outside the United States and Puerto Rico, and your main place of business or post of duty, your tax home, is also outside the U.S. and Puerto Rico, you get an automatic 2-month extension to file your return.
Automatic. You don't have to ask for it.
Automatic. No form needed for this specific extension. It pushes your filing deadline to June 15th, or the next business day if the 15th is a weekend or holiday, so June 16th, 2025, for the 2024 return. You do need to attach a simple statement to your return when you file it, just saying you qualified for the automatic 2-month extension because your tax home and abode were outside the U.S. on the regular due date. But, and this is really important, this automatic extension is only for filing the return. It does not extend the time to pay any tax you owe.
Ah, okay. Payment is still due April 15th.
Payment is still technically due April 15th. So if you expect to owe tax, even with the exclusions, you should estimate that amount and pay it by April 15th to avoid interest charges, even if you file your return later in June.
Good distinction. Now, what if even by that June deadline, you still haven't met the bona fide residence or physical presence test? Maybe you moved abroad late in the previous year and your 330 days aren't up yet.
That's exactly where the special extension comes in, using Form 2350, Application for Extension of Time to File U.S. Income Tax Return. If you expect to qualify for the FEIE or housing exclusion deduction under either the bona fide residence or physical presence test, but you need more time beyond the automatic June deadline to actually meet the time requirements, you file Form 2350. You file this form before the regular due date, usually April 15th or June 15th, if you qualify for the automatic extension. On Form 2350, you tell the IRS when you expect to meet the test requirements. They will typically grant you an extension until about 30 days after that date. This allows you to wait until you've actually met the time requirements before filing your Form 1040 with Form 2555 attached, ensuring you claim the exclusions correctly. But again, remember, this extends the time to file, not the time to pay. Estimate and pay by April 15th if you anticipate owing taxes.
Okay, Form 2350 for more time to qualify. What if you just file on time, maybe by June, without claiming the exclusion because you weren't sure, but then later you realize you did qualify?
No problem there. You can always file an amended return using Form 1040X, amended U.S. individual income tax return.
Yeah.
Generally, you have 3 years from the date you filed your original return or 2 years from the date you paid the tax, whichever is later, to file Form 1040X and claim the exclusion or deduction you qualified for but didn't take initially.
Yeah.
So there's a good window to correct things if needed.
Good safety net. Okay, last practical piece. Where do you actually mail this return with Form 2555 attached? Does it go to the regular IRS center for your old U.S. state?
Crucial point, and one that causes delays if you get it wrong. No, you do not mail your Form 1040104-SR with Form 2555 attached to the regular processing center based on your last U.S. address. The IRS has specific mailing addresses designated just for taxpayers filing from abroad, especially those including forms like 2555. These returns go to a specialized international processing unit. You absolutely need to look up the correct address. You can find it in the instructions for Form 1040, or probably easier, just go to the IRS website, irs.gov, and search for where to file Form 1040 addresses for taxpayers living abroad, or look under the International Taxpayer section. Using the wrong address can significantly delay the processing of your return, potentially holding up refunds or triggering confusing notices. So double-check that address before you mail.
Excellent practical advice. Okay, what a journey through Form 2555. We have really unpacked the details today. From the core purpose of avoiding double taxation to nailing down those crucial eligibility tests, the tax home test, plus either bona fide residence or physical presence, we dug into what actually counts as foreign earned income much more than just salary and what doesn't. And then the big prizes. The foreign earned income exclusion, hitting that impressive $126,500 mark for 2024, and the valuable housing exclusion or deduction for those often high overseas living costs. Plus, those really critical strategic points, the impact on credits like the ACTC, the interaction with the foreign tax credit, that 5-year revocation rule, the stacking rule. It's clear that claiming these isn't just filling out a form, it's making informed decisions. Hopefully, this deep dive has armed you, our listeners, not just with information, but with the confidence to tackle your international tax situation with more clarity and maybe less dread. Knowing where these powerful savings opportunities are is half the battle.
Absolutely. And if we just connect this back to the bigger picture for a moment, living and working abroad, it offers such incredible opportunities for growth, both personally and professionally. But mastering the financial side, including these complex tax rules, isn't just an obligation, it's really a strategic advantage. So the question it raises for you, the listener, is how are you going to use this knowledge? How will you leverage understanding Form 25555 to really optimize your financial journey, wherever in the world your career or life takes you?
In our increasingly interconnected world, being able to navigate these kinds of complex international regulations, it's not just about staying compliant anymore. It's truly about financial empowerment. So are you really maximizing every single opportunity the tax code provides to keep more of your hard-earned income? Or are you potentially leaving significant money on the table simply because you didn't know the rules of the game designed specifically for you?